aggressively ease monetary policy. That happened already in the late 1990s, and it provoked a lot of the Internet bubble. Then, after the Internet bubble burst and 9/11 in particular added on to fears about that, Greenspan did it again, and did it with worry around him, but very aggressively and assertedly with this now famous, infamous 1% interest rate over a long period of time. The second thing that the Fed does, that any central bank does, is regulate financial markets. And not only was there a complete readiness of Greenspan to turn on the monetary dials at extraordinarily aggressively, but also Greenspan himself really embodies quite personally and literally the market fundamentalism that George Soros talks about. In fact, my first economics assignment professional was as an intern working in the U.S. Senate 34 years ago. And Greenspan came up for an appointment as economic advisor, and I was asked to write questions for Senator Proxmire about Greenspan, who was Proxmire was head of the Joint Economic Committee that Nouriel is going to be appearing in front of next Tuesday. And the dominant fact that we knew about Greenspan at the time was that he was a follower of Ayn Rand, who was almost the definer of market fundamentalism, and the idea that there should be no regulation or intervention or protection of the weak in society and all the rest. Now, I don't want to overdo it except to say that we had our central institution getting this profoundly wrong. And when one looks at what the Federal Open Market Committee was saying during the last 10 years, it was that our economy was in a new age, it had unprecedented productivity, and that our financial markets were, by definition, self-regulating. And so I think there is even a locus where this turned out to matter so decisively, because when that core institution doesn't work, it didn't work in a fundamentally different way in the 1930s, but it didn't work during the last 10 years in its two core assignments. And that brought us to this extraordinary circumstance now. Now, why is our situation so extraordinary at this point? I think I would just add a couple of thoughts to the two extremely lucid presentations you just heard. We went through a bubble between 1998 and 2001 that was very similar to what we're going through now, but it was in the stock market, in the dot-coms. Crazy, vertiginous rises of stock market values. But when that burst, it did lead to a slowdown of the economy, but it didn't lead to this unbelievable drama that we're going through now. So what's the difference? Really, two things are different now. One is that this has been going on longer, so there has been more time for households to take on debt, more opportunities because of financial engineering, low interest rates, and all the rest that was just discussed for households to get seriously undercapitalized themselves, so that when the process of easy lending stopped, we have the core of the demand in the economy, which is the household sector, in vastly worse shape than it was in the year 2000, 2001. But there's a second feature which was also hinted at, which I think is very important to understand. And that is, and they explained it perfectly, but I just want to underscore it for people, and that is that this time, unlike simply the fall of stock market wealth, which came with the dot-com bubble, the payment system, the credit system is implicated in this collapse in a different way. When asset prices in the dot-com bubble broke, people got poorer. When asset prices this time broke, highly leveraged financial institutions found themselves profoundly decapitalized and in some cases insolvent because the assets that they were holding, whether they were the mortgage-backed securities or the CDOs or other kinds of assets, fell in value. And because the other side of the balance sheet that had enabled these financial institutions and investment vehicles to purchase these securities were short-term loans made by from money markets and from international investors rather than capital of the enterprises themselves, these being highly leveraged investment vehicles, even modest declines of asset values meant that the financial institutions were put into extreme financial distress. Many were closed down in 2006, 2007, and up till the middle of 2008. All of that shut down various lines of financing for our economy. For instance, a lot of the ways that the housing boom was being financed through the kind of Wall Street operations that George and Nouriel talked about closed already during 2007, 2008, meaning that housing construction started to shrink, and that accelerated the peak and then the decline of housing prices and the downward spiral. But the real break in the system, as both George and Nouriel said, is when this turned from an embarrassment of financial institutions and a decapitalization of banks, which would squeeze lending in the economy, to a full-fledged outright panic, the likes of which we haven't seen in more than 70 years since the Great Depression. And that panic came when Lehman Brothers defaulted on short-term money market paper, because then nothing was safe. And when you look at the events from September 15 to September 17, what was already a highly recessionary, contractionary environment turned into this massive global ricocheting around the world as every major financial institution was a threat of a self-fulfilling, panicky withdrawal, not by depositors so much who were typically protected by deposit insurance, but by those who were buying commercial paper and the short-term money market instruments issued by these companies. That's when the specter of a deep recession turned into the realistic specter of a complete crack-up, meaning an economy not declining by 3 or 4 percentage points, but at risk of declining by 10 or even 20 percentage points, as in the Great Depression. I think we probably all feel right now that that risk has been mostly put under control, not definitively by any means, because there are huge surprises still out there in many, many parts of these instruments whose counterparty assurance is completely unknown, like the default swaps. But the readiness of governments all over the world and central banks to put in more than $3 trillion of backing within a couple of weeks is probably the difference of the self-fulfilling utter collapse of the kind that one saw in a Great Depression and a bottoming out that means that we will face only hardship of recession rather than depression. Now, you may ask, and I think it's a very good question, well, why do we need even a recession if we understand all of these things? You know, why don't we just fix the situation if it's really true that we now see through this? Why do we have to just stand blindly as the economy continues to fall? And that is because what's really been happening in the economy